Welcome to the Zero Hedge debate sponsored by JM Bullion. Hi, guys. It's great to see you. And I'm very interested to hear both of your views on the bond market. From what I understand, you're on the other side of each other's trade. I thought I knew that. But in any case, probably the best way to do this would be for each of you to kind of give an overview on why you're bullish or why you're bearish, and then we can just kind of have a dialogue. And I'll try to stay out of the way unless there's a question I think that I might ask that might be useful for the listeners. So since you're on my left, Jim, why don't you go first, and David can go second.
Thank you, Bill. Thank you, Jay and Billiam. Thank you, David. Look forward to the debate about the bond market. Since it is a debate, I'll start off by saying I was born to a middle-class family, and we'll go from there. Uh,
Well,
But
I
are
guess
you
it's over. I guess it's over then. That's all you need to
but
say.
are you
you're
going to
right.
call yourself a knucklehead?
Later on, when we get there, when we get there. Um, I have been of the opinion that the long-term economic cycle turned in 2020, that the 40-year bull market in bonds ended in August of 2020 when the 10-year yield hit 51 basis points on a closing basis. That cycle corresponded with a financial crisis and a recession around the shutdown restart of the economy with COVID in 2020. I believe that every time you see a financial crisis or a recession, and we had both, the economy changes. Change does not mean worse. Change does not mean dystopian. Change means different. And coming out of that cycle, we are now in a period of higher nominal growth, stickier inflation of around 3%. The first move in interest rates was from 0 to 5%. That was extraordinarily painful for any bond investor because you had no coupon to cushion you. The total return losses were among the worst ever recorded. But now we're on the backside of that. We're at a 5% yield. Moving forward from here, I think what we're going to see is the economy is going to stay, to use the airplane metaphor everybody loves on Wall Street, more in the no landing camp. I'm going to define a no landing as about 2 to 2.5%. I think that inflation is not going to make it back to 2%. I think we're at the cyclical lows here or around here, and that we're more in a 3 to 4% inflation world, which means that we're in a five-ish nominal world for growth. All things being equal, you should probably see interest rates somewhere in the high fours to 5% as somewhere approximating a neutral rate. Now, I know Wall Street thinks that the neutral rate and the Federal Reserve thinks the neutral rate is far lower than that and is intent on cutting interest rates far more than that. And what I fear is if we do see them cut rates to the low threes, on top of the fiscal stimulus that we have, we're going to overstimulate and we're going to see an inflation problem in the second half of 25. And the bond market will start sniffing that out well before that. So that's the bigger picture that I've been operating under for the last couple of years. I'll stop there. Dave, I'll let you give an opening statement as well.
Sure. Well, look, I would say that firstly, inflation is already down to 2%. It's not at 3. And we're pretty well back towards the inflation rates we had pre-COVID. And I guess the question is, where's inflation going from here? And it's not going to be a straight line. And of course, we've seen what's happened with the base metal prices because of the Chinese stimulus measures in the past couple of weeks, and oil backing up um, based on the geopolitical tensions in the Middle East. But the trend, I mean, if you look at the chart, there's nothing sticky about inflation. It's come down almost as fast as it went up. And the reasons it went up, I don't know so much about Jim's comment that we've seen some sort of big secular shift. Uh, I think what happened was that we had, as Jim had mentioned back in 2020, a temporary period of, you could almost call it deflation, because of the demand destruction initially, because of COVID and the lockdowns. And then the economy reopened much earlier than people thought, but the government kept on stimulating both the central bank and the fiscal stimulus check giveaways, which was a gift they kept on giving right up until the past few months. So I always look at inflation, which is the aggregate price level, or say the CPI, which is the consumer prices, or PC deflator. Whether you're going to forecast as an economist the price of anything, it could be gold, it could be real estate, it could be labor. You have to have a supply and demand framework. And it's incumbent on the economists to get the shape of the supply and demand curves correct and the movements. But it's just a incontrovertible truth that the price of anything will be the intersection of supply and demand. And we're not talking about the price level, but the change in the price level, which is the inflation rate. How far is it moving? So you see, when I take a look what happened in retrospect in 2021, 2022, especially coming off the worst part of COVID and then the reopenings and then all the stimulus. We had a situation where because people were paid not to go back to work and because of the labor demand supply mismatch that we had for a couple of years and the female participation rate diving because women in particular were scared to go back to work because of lingering fear over the pandemic, we had a severe depletion in the supply of labor at the same time when we had no productivity growth. So you see, we had a very sclerotic, inelastic supply curve for a period of about 18 to 24 months, and it bumped against all the rampant fiscal stimulus and monetary stimulus. So we had this massive imbalance between aggregate demand and aggregate supply. And the next thing you know is that in fairly short order, inflation goes from 0 to 9% by the summer of 2022. But look what's happened since then. Inflation's gone from 9% down to 2%. And that's because we've had a reversal in these demand and supply curves. And Jim's quite right. The economy, despite the fact I've been bearish on the demand side has held in reasonably well. You can call it between 2 and 3%. But you can't forecast inflation just based on demand alone. The question is, what is supply doing? We got the employment numbers today for September, and the pool of available labor in the United States. Now, part of this could also be the immigration story, but it doesn't really matter. Labor supply in the United States is expanding at a 6% annual rate. But the most astounding thing on the supply side is that productivity has accelerated to 2.7%. You've got almost 9% growth at an annual rate in the supply side of the US economy, which is about triple, at least triple, what the rate of growth of demand is. So if you're going to have an inflationary view, you have to have a view as to what's going to happen with the supply of labor going forward, and you have to build assumptions, and what's going to happen with productivity. Productivity is an absolute inflation killer. And frankly, I don't really care if nominal wages are rising 3 to 4% at a time when productivity is running close to 3%, because it means labor costs are running basically around 1%. Now, that's a straw man I'm building. As we sit here right now, the year-over-year trend in unit labor costs a year ago, productivity adjusted labor compensation was running close to 4%. It's running at 0 right now. And it's not because we've had any serious detonation in the labor market. The non-farm payroll number for September settled that debate, at least for now. But it's the productivity numbers that are inherently disinflationary and why labor costs are running at 0. So as I taking a look at the supply side of the economy, and remember that the productivity boost has come even in advance of what AI is going to bring in the future. This is leftover from COVID. COVID actually ended up proving to be a serious boost to productivity, especially in large parts of the old economy, like healthcare and retail. In retail, during COVID and the lockdowns, you either had to digitize and automate and become Amazon, or you're going to go under. So you're seeing actually in the areas of the economy that you would never expect to see productivity growth accelerating, well, those are the areas that are really accelerating. And that to me has been the most impressive part of the cycle. But that's why it's not the 1970s when productivity was stagnant. Something's happening here on the supply side of the US economy that you could argue is very beneficial for economic growth, but it is inherently disinflationary. So if you're going to have a view that inflation is going to come back and you have to have a supply demand framework, either have a view that for some reason, and maybe it'll be fiscal policy, maybe we'll have one party rule. I don't think that's going to happen, but whether it's Harris or whether it's Trump, we'll get, if they manage to take the House and the Senate, we'll get tremendous fiscal stimulus, and I'll have to redo my estimates of aggregate demand in the future. And the question then becomes, what's aggregate supply going to be doing? You can't have an inflation forecast without those two curves, and those two curves right now are still telling me that the fundamental trend, notwithstanding the bumps along the way, the fundamental trend in inflation is going to be down and not up from where we are today.
Okay, so before we sort of have each of you talk about the other one's points that you might like to challenge, how about we do this? Why don't you give me a quick snippet of, summary of what you would want to see, Jim, to conclude that you were wrong, and then I'll give you the same opportunity, David. So I'll let you argue against yourself before you kind of take on each other's data points, if that's okay.
So to start, I think it really does come down to the inflation story right now. I'll use year-over-year CPI as a metric for inflation, but I think it really applies for most of the other numbers. It was 3% in June of 2023. It got to 2.9% in August. Excuse me, in July, and it got to 2.5% in August. So basically, over the last 15 months, it's really slowed down quite a bit. We have yet to see the core, I'll flip now to core PC. We've yet to see that even approach 2.5%. It's still at 2.6% right now. And everybody still thinks that it's going to be coming lower. I'd like to see those numbers start to accelerate lower. They really haven't. I do think that we are in an era that we are in sticky inflation. And what I will argue later on is there's been massive change to the labor market. Remote work and immigration are probably the two biggest things that have really changed the labor market in a lot of ways. And I would also argue that immigration has also been pushing on this difficulty that you've seen with housing prices, because housing prices continue to make an all-time high in the United States, especially if you look at it at a square foot basis as Redfin measures it, even though starts and sales and affordability is down. So I'd like to see the inflation rate continue to come down. I'd like to see housing prices peak and come down. But neither one, I would argue, isn't yet. And until then, I still think we're in that secular turn in the market. And we're in a period of, like I said, 3 to 4% inflation, not 2. Now, I'm not in 8, 10 Zimbabwe type levels of inflation as well. And finally, what I'd also like to see is I'd like to see fiscal spending slow down. At 23, 24% of GDP, we are currently spending more now than we did in previous recessions, except for COVID and the financial crisis. You look at any other recession other than those, the current level of government spending is higher now than it was at the peak of any of those recessions. I like to say that alone should probably keep the inflation rate sticky because of the massive demand push that you'll get from the government because of all of its spending.
Okay, so you argued against yourself, and then you argued a little bit for yourself, but I understand.
Mhm.
David, I'll turn the ball over to your court.
Well, I think that the risk to my forecast, I think mostly would come from the supply side. Um, for example, uh, what's happening, for example, in the Middle East, if the war really turns ugly between Israel and Iran, we could have a situation again where that has implications for not just oil prices, but also global supply chains. So that would be a negative for my view from a production bottleneck standpoint. Um, if anything stands in the way of productivity growth, and look, we have to take a look at, thankfully, the dock workers are on the East Coast and the Gulf are back at work, but they're making automation a key part of what they want to see after the contract extension next January. Anything that impedes technological progress is clearly something that would stand in the way of my view. I'm nervous to the extent that if Trump wins and there's a Republican sweep, we're going to get fiscal stimulus. And the Trump tariffs will, of course, be a major complication if he ever dared to go through with the size of those tariffs. But it's not really a sustained source of inflation because it's not as if he's going to raise tariffs 100% every year. It'd be like a massive level shift. And then we know in his last presidency that inflation didn't go up, despite the fact everybody thought inflation was going to go to 5 or 6%, and it actually went down from 3 to roughly 2, despite the fact that he built that immigration wall around labor and the fact that he still raised tariffs, although not to the extent that he's talking about right now. There'd be some other supply side benefits from the fact that we know that he's a deregulationist, and cutting corporate taxes actually will help capital formation on the supply side. But overall, it'd be tough to build a GOP sweep with a lower inflation outcome. I'd have to revise my view. And so I'll wait till November the 5th. That requires really one party rule. The same is true with the Democrats. And I think that between Kamala Harris's spending and her tax breaks, her subsidies, I think that inflation, notwithstanding the fact that we'd have a tariff price shock, it would be temporary. Under Trump, I think inflation will be more of a problem if she wins and both the House and Senate are Democrats. So if you're asking me really both from what I would have to do to change my supply and demand framework, we'd have to see one party win, one party take all on November the 5th. That would cause me to do a serious reassessment of my fundamental view.
Now is the time to take advantage of the power of gold and silver to grow your wealth, whether you're an experienced investor or new to the game. These precious metals have a long history of being a safe haven for your savings, but they also offer growth potential, making them a wise investment choice. So where does the average investor go to buy gold and silver? That's easy. JM Bullion. JM Bullion is one of the most popular and most trusted precious metals retailers in the nation. We offer a huge selection of gold, silver, platinum, and palladium products that can be delivered to your door in safe, discreet, fully insured packaging. From 1 gram of gold to an entire mint box of silver, JM Bullion offers precious metals to suit every financial goal and budget. No matter your budget, now is the time to start investing in precious metals and start protecting yourself and your savings against these volatile markets. Visit jmbullion.com today to take a look at our wide variety of precious metals, rounds, coins, and bars, and find out how you can turn your savings into gold.
Thank you. Okay, I want to toss out a question for you both that I don't see get discussed much, and I think it's kind of important. You may either agree or disagree, but what I want to talk about, or what I'd like your views on, is the psychology of the bond investor. And what I mean by that is a lot, the perception of what may happen down the road may impact what people demand in terms of a rate of return. When I think we all got into business in the early 80s, and I remember vividly that the viewpoint then was the 10-year or the 30-year needed to yield the inflation rate like plus 2 or 3%. Okay, and of course, as we went through the 25 years of the bond bull market, that kind of went by the boards. But I suspect that it could matter given the fact that the size of the deficit is so enormous, and as we all know, the size of the deficit hasn't really mattered thus far. Other countries could be considered in trouble when their deficit was as big a GDP as ours is, but that hasn't been the case. However, I remember vividly in '84 when the bond market backed up to like 12 or 13% again, because at that moment in time, people thought inflation was kind of roaring back. It wasn't. It was one of the best bond buying opportunities of all time after the 81 peak. But I've always been struck by the psychology of that period. And so I'm wondering if you guys think that the size of the deficit and the people's view that the propensity of the Fed maybe to err on the side of easiness might factor into this equation in a way that it hasn't in a while. So that's my complex question for you.
Yeah, I've gone first. Why don't you take a stab at going first?
Who, me?
Yeah.
I'm trying to figure out if that was that a question or was that a soliloquy?
Well, I was just trying to set the stage for how in my mind psychology can matter a lot in investing. We see it in equities all the time, but I bet it seems to me it can factor into bond prices. You may think I'm crazy.
I don't think when it comes to the bond market, maybe when it comes to the credit markets and the spread market, which are tied more closely to risk, and the stock market, you could talk about psychology. I don't think there's a lot of psychology in the bond market. Bond market is really pure math.
Well,
And
then, what?
I
Well,
think
then,
rationality. Well, let me just say that.
okay.
Well, let me ask you the question. When you hear the term animal spirits, have you ever heard animal spirits referred to a bond market investor?
Yeah, absolutely.
I have too.
Jim Grant had a cartoon in 1986 that showed a guy jumping up and down on the desk screaming bond fever. I remember how wild. I mean, look, back in 81, 80, 84 period, we were buying zeros in equity accounts. And the reason I bring that up is I still to this day don't know why they backed the bond market up to 14% or 13% in 84. I've always attributed it to psychology, David, that people didn't believe that the Fed had conquered inflation. You may have a different explanation.
I find that I find that psychology and sentiment is a far bigger driver of risk assets than for risk off assets. I've never heard the term. I guess you're telling me you had to go back to 1986 to find a chart that would have depicted uh, animal spirits in the bond market. And I would say exactly, you got to go back 40 years to find any such graphic. The bond market, you have to weigh what the correlations are. What are the correlations? Like, the bond market is what it's a sum of inflation expectations and real rates, expectations of the Fed, economic growth. I wouldn't say there's animal spirits. Of course, you have to factor in assumptions and estimates as to where these things are going to determine where you think the appropriate bond yield is. But I don't believe that's sentiment. That's just math. When you're taking a look at where a bond yield is, it's the sum of all these different components I was just talking about. Quite simply, where real rates and where inflation expectations, and most of the job is done. The stock market is the product of two numbers. Really, it's earnings, which are hard, but the multiple, and the multiple you put on earnings is actually animal spirits, which move up and down. There's no such thing as a multiple in the bond market. The multiple applies to the stock market, and the multiple in the stock market is a level of investor confidence. So it's two totally different valuation metrics. In terms of the comment on fiscal policy, you mentioned the 1980s, and Treasury yields peaked in the early 80s, and then they just kept on going down. It wasn't a straight line. And all Ronald Reagan did was just add more and more to the public debt and add more and more to deficits. And that didn't really change until we had a couple of years of surplus with the benefit of the proliferation and dissemination of the internet and all the capital gains that took in for Bill Clinton towards the end of his tenure. And I've actually found that in years where we're running low deficits or surpluses, bond market has more of a difficult time than when we're running deficits. So people would have to explain, for example, how it is that since October of last year, we've tacked on $1.5 trillion to the national debt in terms of accumulated deficits. And the Treasury yield, even with the backup in the past couple of weeks, we're still down 110, 120 basis points. And that's because what are the correlations? What matters for bonds most? I'm not going to say that fiscal policy or deficits don't matter, but they have a 20% coefficient when it comes to determining the direction of Treasury yields. But there's so much more that go into the determination of where market interest rates are going. So what's happened basically is this. What's happened is that we've had a situation where the Fed stopped raising rates, and the Fed's embarked on an easing cycle. We don't know how far it's going to go, but that's really what shifted is Fed policy, Fed expectations, and then on top of that, we've had what's happened with inflation and inflation expectations. So I look at deficits and debts in the public sector. I don't look at it in a vacuum. I take a look at it in the context of what's it doing to inflation? What is it doing to inflation? Now we have fiscal policy dramatically exacerbate inflation in 2021 and 2022. And we can all talk about dramatic fiscal stimulus. Fiscal policy right now is neutral in terms of its impact on the economy. But if we have a situation where fiscal policy, deficits, and debts create the conditions for accelerating inflation and inflation expectations, then you get into a bear market in bonds. But you can't just say, oh, well, I'm so concerned about debts and deficits that I'm bearish on treasuries. It's not that simple, because you'd have been bearish on treasuries right throughout the 1980s, because all Ronald Reagan did, as I said before, all he did was add significantly to deficits and debts. When I started in the business in the mid-1980s, what replaced the weekly money supply numbers on Thursday were the monthly trade and budget numbers. And remember, twin deficits, sell your bonds, twin deficits. That didn't turn out so well, notwithstanding the fact that there were gyrations along the way. But Ronald Reagan presided over a ballooning debt and deficit situation. Treasury yields didn't go up because he also embarked on significant changes of top marginal tax rates that led to significant improvements alongside deregulation on the supply side of the economy, to come back what I talked about before. So I refuse to forecast treasury yields with one or two variables. I do not have a one or two variable model. Okay. You have to take a look at the whole pie, a holistic view. But deficits and debts only matter insofar as they create the conditions for an inflationary, deflationary, or neutral output gap. That's all that matters in terms of your bond yield determination.
All right,
So
Jim,
let me
you want to
take
take some question?
Yeah, let me take the other side of that. And Bill, no, the bond market has a unique feature to it that most risk markets don't have. There's no leverage requirements in the bond market. You could I could go buy $1 billion worth of bonds right now without any money. I just need to get some dealer to willing to sell them to me. And so therefore there is a big animal spirits in the bond market.
How
And
is
it
that animal
is
spirits? How is that? How do you define animal spirits?
the psychology of the market gets overdone in both directions, and it gets overdone by the idea that everybody's rushing to buy or rushing to sell. Dave, you mentioned that in stocks you have term premium in the bond market. That's basically your animal spirits in the bond market is term premium.
Why is that animal spirits? That's basically just an expectation of a different way of looking at where Fed policy is going. Why is that animal spirits?
Well, isn't monetary
It's not the
policy? I
same.
mean,
It's not the
the
same as
multiple
the
is the
multiple.
same
It's not the
thing.
same.
The
It's not the
multiple.
same as the price. It's not the same as the PE multiple,
The
which is
PE multiple
definitely.
goes up and down based on people's changing perceptions about growth or about the economy or about inflation or about interest rates or about earnings if you're talking about an individual company or management. So they go up or down based on judgment. The term premium goes up or down based on judgment, in other words, not math.
But
And that is a
when you're
big
expecting
part.
Treasury yields to go down, your ipso facto have probably a pretty downbeat view of the economy. How's that animal spirits? That's negative animal spirits. So I'm basically going to borrow money.
There's bear market animal spirits in the
Emotions,
stock market
emotions,
too.
Bear market animal spirits.
There's
Okay.
greed and
All right.
fear. There's greed and fear.
Yeah, exactly.
That's a
It's
fear.
emotion. It's just emotions. Another way of saying emotions.
Right.
I
And
mean,
I mean, just to give a couple of more recent examples, animal spirits. Please explain to me negative interest rates and why people were buying negative interest rates and why bond managers were willingly to buy negative interest rates is one example. We saw it in 2020
it was
with
because it was based on
we saw the unwind of the basis trade
it was based on a forecast of, well, the negative interest rates were perpetuated by central banks. Central banks are keeping their policy rates negative in most
nobody forced bond
and
managers to buy negative
and
interest
so
rates.
and everything got anchored to what the central bank was doing.
Yeah, at the
Everything
front
was
end of the curve,
anchored
but
to
nobody
central
forced
bank.
a bond
The the
manager. Nobody
the
forced a bond manager to
multiple on
do
the
it.
stock market reflects confidence over the economy and over sustainability of earnings, right?
Every double auction market has greed and fear, has psychology in it. Whether you're talking about the bond market, whether you're talking about the stock market, the commodity markets, the currency markets, even if you're talking about the treasury bill market. We saw that last year when we saw the idea that we were going to have a government shutdown, and we saw enormous spreads between treasury bills that matured in October and treasury bills that matured in November. And that was all animal spirits too, based on judgments that get overdone in both directions all the time. So yes, the bond market has that. It is a double auction market. For every buyer, there's a seller. And that is what you lead to these animal spirits. And I think that I understand your argument as being, well, it doesn't move a whole lot. It's a very low beta type of market. The return on the Bloomberg Aggregate Index this year is up about 5% for the year. That's a decent year. It doesn't go up 40 or 50 or 60% like stocks or crypto can go up. But to compensate for that, there's a lot of people, hedge funds, dealers, and stuff that buy with tremendous leverage. Witness Lehman Brothers. Witness a lot of these players that get in trouble all the time in the bond market because they over leverage themselves. So yeah, there is a lot of animal spirit in the bond market. And to the second half of Bill's question, the animal spirits in the bond market are off the scales right now. So let me share my screen here real quick. Where's the screen share button? There it is. I want to just run through just a handful of charts. And I could draw on the screen too. These charts come from the September Bank of America Fund Manager Survey. They have done this survey now for 20 years. The first question is, 90% of investors think that the yield curve is going to steepen over the next year. 90%. That is the highest ever recorded. This is same fund manager survey, which by the way is 200 managers with about $600 billion. 59% of them think that bond yields are going to be lower in the next year. That is the third highest number in the 20 odd years that they've done this survey. And the only other numbers were November and December were higher than that. And what did we do in November, December? We went straight up 90 basis points in the next 3 months, which then put us at that lower number in April before we've rebounded. University of Michigan asks a survey of what I'll call civilians, the public. 600 people fill out a web survey for the University of Michigan. Do you expect interest rates to go up, down, or stay the same in the next year? 54% of them think that rates are going to fall in the next year. They've asked this question for 45 years. This is the most optimistic that rates are going to fall in its history. It equals the June 1980 peak in this number.
But they seem to be right at those peaks.
No, wait, actually, if you wanted to talk about all these peaks,
2020, 2000,
right,
1990, 1980, yeah, they all seem to be. I think right there at that very first circle is when Bob Farrell and Chuck Clow and the whole group at Merrill put out their big bond bull report for the next decade.
So
that's
let me point out. Let me point out
you showed that chart, but actually, instead of being a contra indicator, it's actually pretty spot on.
Oh, hold on a second. Okay, you're right. Okay, but let me point out, I didn't put on this chart here. Recession, 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 recession. No recession right now. There is no recession right now. Every other time they were at one of those peaks, we were already in a shaded area, according to the National Bureau of Economic Research. We didn't know that at the time, but we found out after the fact. The economy is falling apart. By the way, stocks down, stocks down, stocks down, stocks down, stocks getting crushed, all-time high. So that is the difference now versus then. Why is everybody so bullish on the market right now? Because they've been told 7,000 times the Fed's going to cut rates hundreds of basis points over the next year. That's what they're pricing in on this. The commitment of traders report, the unlevered asset managers are at an all-time high in their net position as well too. So you sum it up, and what you have in the market is, Dave, you have the overwhelming position in the market right now. We are bullish. We think rates are going to go down. We think the yield curve is going to steepen. And I don't know quite how that's going to work in a bull steepener. We could talk about that a little bit later. But that is where everybody is. And in a double auction market, that means you have to generate new buyers in order to keep the market going up. What you have is you have buyers sitting on their hands, waiting for inflation to fall, the economy to at
Well,
least soft land, if not
let me ask you
hard
the
land.
question. Wait,
Things go further.
wait, hold on. Waiting for inflation to fall when it's already gone from 9 down to 2. They're not waiting for inflation to fall. Inflation has fallen. They're not
That's
waiting
why
for the
that's
Fed.
why
They're
we've
not waiting
got
for the Fed to
20-year
cut
highs
rates.
in
They're not
bullishness.
waiting for the Fed to cut rates. The Fed has cut rates, and Powell has already said that it's not one and done. It's going to be a process. He told us that 2 months ago. So they're not waiting for anything. The unemployment rate has gone from 3.4 to 4.1. So we're building up slack in the labor market. It sounds actually, whatever the positioning is or the views, it seems to make, if this was, you were showing me this like 3 years ago, I'd say, well, that's just nuts. But nothing you show me actually sounds perfectly rational.
So what do you guys make of the fact that the Fed just cut 50 basis points and the 10-year's up about 40 basis points? I know it could be market noise, and that happens a lot, but it seems to me that's not a response we see very often when the Fed moves in a way like they did to see the bond market back up this hard.
It happens almost all the time. Happens almost all the time. I mean, surely you were around in September 18th, 2007, when the Fed cut 50 basis points. And then within 3 weeks, the 10-year note was up like 30 basis points. And the stock market went wild. The stock market didn't peak till October. They cut rates 50 basis points intermeeting January 3rd of 2001. And the stock market surged that day, surged. And treasury yields backed up substantially over the course of the next month. Actually, I went back and looked in periods, even when they go 25 or 50, the market sentiment, whether it's in commodities or it's in stocks or bonds, is that the Fed came to the rescue. So there's always a knee-jerk risk on trade after the first cut. This is actually not abnormal at all.
So
Let's face facts. Some stuff has happened since then. China has stimulated, creating like all of a sudden the Chinese and the Hang Seng, their markets have gone from bear markets to huge bull markets. It's added on. I think you've got animal spirits going on in the Chinese stock market right now, and it's spilt over into the Hang Seng, and it's spilt over to iron ore and the base metals. So you've had base metals have hooked up a lot, not in anything outside of hopes that China got it right this time. And then we've got this Mideast war going on that's caused oil prices, although they're still down from where they were a year ago, but they've hooked up. So you've had some other things happen, right, that might have caused investors to sort of shy away from duration, notwithstanding what the Fed did just 3 weeks ago.
I'll agree with you that there's been some stuff that the Chinese stimulus is a big deal and that the Mideast war is a big deal, but I think there's something more fundamental that's different about this rate cut cycle. Let me remind you, back on the chart I showed you the civilians, that everybody expects interest rates to go down because they've been told over and over that the Fed is going to cut rates hundreds of basis points over the next year. I'm going to share my screen again. I'll show you a different chart here. Here's the 2-year funds rate. So in blue is the 2-year note. In orange is the funds rate. The bottom panel here is the 2-year funds rate spread. It got to minus 182 basis points 2 days before the Fed cut. That is the second lowest number it's ever been in the 40 years I show you. It was minus 184 at the beginning of the financial crisis. Let me define that for you. The entire rate cut cycle is priced in. The entire rate cut cycle to 3%. If the Fed moves the funds rate to 3% over the next year and a quarter to the end of next year, the 10-year yield, the 2-year yield should do nothing. It's all priced in. If we go to 2, then maybe we've got some reason for the front end of the curve to rally, the 2-year note. If it stops at 3.5, it's going to be severely disappointed, or 4, it's going to be severely disappointed. The entire cycle is priced in. There's nowhere else for the front end of the curve to go. Now, let me give you another thought here. What is the average 2-year funds rate spread? If 90% of managers think that the curve is going to steepen, the curve is going to normalize, where does 2's funds go? What is it? At 40 basis points, it's been its average. So if the Fed cuts rates to say 3 to 3.25 plus 40 basis points, where should the 2-year note trade in a year? It should trade around 355 to 360. That's where it was at the beginning of the week. It's higher now because of today's payroll report, but we're effectively there right now. Okay, so that's where the front end of the curve is supposed to trade. So where's the back end of the curve supposed to trade? Here's the 2-year, 10-year, the 2-year, 10-year, and the spread between those two. The average rate, the average spread on that's 100 basis points. So if the 2-year bottoms at 360, the 10-year goes to 460 on a normalized curve. That's 70 basis points higher than we are right now. Animal spirits, the market has priced in the entire move because this move has been telegraphed like no other move, to the point where civilians are telling the University of Michigan they're expecting that we're going to see lower rates to a degree they haven't said in 44 years on that survey. There's no room left for this market to go lower. I'm talking about market yields, 2s to 10s, unless you give me 2 scenarios. Scenario 1, that the economy's far worse than we think, that everybody is way too optimistic and it's going to get far worse. Or number 2, the yield curve is not going to normalize. It is going to stay at its relatively flat to inverted curve, frustrating all of the yield curve steepening calls that everybody has. Again, this last chart here, and I'll stop my screen, this is unusual. 180 basis points. That is the 2-year note pricing in the entire move 2 days before it began. And why is that unusual? Because we've never had the Fed so telegraph such a move before. So I would argue to you that the fall in market-based yields based on easier Fed policy is largely behind us. Now we're just going to wait to see if our expectations of what the Fed is going to do meet up with the reality of what they actually do. Do they come up short, or do they go much further lower on rates than we thought?
Go ahead, David.
Well, I'd say that I don't disagree with Jim one bit on the call that the markets have priced in the Fed to basically get down towards its own estimate of neutral. And then it comes down to your macro view. I don't, to be honest, I don't care if the recession has shown up yet or not shown up yet. Nobody saw in 2000, we had the same discussion. Recession shows up in 2001. Oops. We had the same discussion in 2006 by the end of 2007. Recession that nobody saw comes. So I believe in, I don't think the business cycle has been repealed. And I think for a variety of reasons, the lags between what the Fed has done and the ultimate impact on aggregate demand, we haven't seen that yet. But it got clogged up a lot by the excess savings file and the other forms of fiscal stimulus, which are now subsiding. So I'm still in the recession camp. So I guess this is a case where your assumptions drive your conclusions. And in a recession, 90% of the increase in the funds rate in the previous tightening cycle gets unwound. You could be talking about the funds rate getting down back towards 1 or 1.5%. Now, the Fed let the cat out of the bag, and nobody even caught it. And nothing moves in a straight line. You know, the Treasury yields have backed up since the last meeting. But I'm more interested in the destination point. The Fed told us in its latest forecast that expects the unemployment rate to get to 4.4%. It bottomed to 3.4%. They're telling you we're going to have a 100 basis point increase in the unemployment rate, which has never before failed to happen in the context of an official recession. They actually laid it out there for us. If this was a soft landing, then the unemployment rate would have peaked at around 3.8%. It's right now, after today, at 4.1. And they're saying it's going to go to 4.4. It's hard to build an inflationary forecast when you have increasing slack building in the labor market. But they're telling you. And now, of course, because they're all economic cheerleaders and we have an election, they're going to come out and say there's a recession. Now, you listen to Austin Goolsbee, who I actually believe is the sharpest guy on the FOMC, and very influential. Not just him, but Waller, who's a governor. Goolsbee just came on and said, with or without a recession, rates have to come down and come down by a lot. And I think that's actually going to happen. Now, the Fed, just to get to its current estimate of neutral, and nobody knows where neutral is. And I'm not going to waste my time debating where neutral is because I don't think anybody really knows. It's not an observable number. But the Fed, with all its PhD economists, does its best, and it's 2 7/8. And if we actually have a recession, which I still think is not 100% odds, but I think it's actually higher than most people think,
is it over
then the
50?
funds rate is going to come down a lot lower. So I agree. I agree with Jim, because when you run the regressions, you'll see that Fed policy, the cost to carry, the expectations of the Fed actually has the most powerful explanatory power on where yields out the curve are going. So yeah, I would tend to agree that if the Fed stops at neutral, there's no value left in the front end, and you could argue that a normalized yield curve would mean that longer dated yields have to back up. But that's not my view. My view is that the business cycle has not been repealed. My view is that because the recession hasn't shown its ugly head yet, to say that it's not going to, I'm frankly, I'm not there. I'm not there at all. I do believe in the leading indicator. I believe in the inverted yield curve. I believe that we had the largest interest rate shock since the early 1980s in an intensely credit-driven and rate-driven economy. There's things that have clogged it up. I mentioned fiscal policy being one of them, excess savings file, another one. The fact that so many people locked in, whether you're corporate or whether you're a household, and especially on the mortgage side, bought you time. But at some time you will have to renew. At some time you will have to roll over. And when you're taking a look at interest rate cycles, you'll see that in an easing cycle, whether or not we go into a recession, when we don't go into recession, what the Fed does is it takes the funds rate in line with the average of the previous 5 years. And that would mean they'd have to go more than 200 basis points, more like 250 from where we are today. In a recession, they take the funds rate well below the average of the past 5 years, because that is how you get stimulus into the economy. Right now, policy is still very tight. You're taking a look at corporate borrowing rates, mortgage rates, auto loan rates. They're between 200 and 300 basis points above the average of the past 5 years. We haven't had a gap this big since the early 1980s between spot interest rates, even after the first rate cut, and where the trend was over the past 5 years. You see, we're just basically whistling past the graveyard. It's like basically what me worry. But people have no idea that this was the biggest interest rate shock since the early 1980s. And there weren't as many factors clogging up the lags like there are this time. But I still think that there's not going to be a get out of jail free card coming out of this tightening cycle. And I think the Fed actually, they went 50 basis points only because they had 25 on the table at the previous meeting in July, and they opted not to go. And then they figured, okay, we were going to do 25, we'll just go 50. That's why they went 50. They just thought they were probably a little bit, for the time being, behind the curve. But you listen to Austin Goolsbee, and I'll tell you, you have to take a look at, and I know Jim says, well, they're saying rates are going to go down. They're saying rates are going to go down. But I'll put my money behind Austin Goolsbee because, like I said, he is the brightest guy in the room. And when he says rates have to come down and come down a lot, well, I would say that at a minimum, the markets are priced for that. But I still think that a recession is not off the table. We get a recession, that funds rate is going to have to go back to around 1%. And then we have to redo, and I don't think there's a zero probability, Jim, of that happening, but we'd have to weigh in what if there is a recession. And when I hear that, well, there's been no recession, yet. I've been in the business 40 years. I heard that in 1989. I heard that in 2000. I heard that in 2006. And maybe it'll be different this time. A lot of people are saying that. But I said before that my inflation call does not need a recession. It just needs these demand supply curves to remain intact. But I haven't abandoned the recession call, not a bit. And we get a recession in the next year. Then the Fed is going to be scrambling. And the funds rate is not bottoming at 3%. It'll be bottoming a lot lower than that.
At JM Bullion, excellent service and competitive pricing aren't just goals. They're our standard. Our commitment to customer discretion and privacy with secure and confidential transactions has earned us an unparalleled reputation as an online retailer of precious metals, backed by over 375,000 reviews, averaging 4.8 out of 5 stars. Only at JM Bullion.
Okay, let's do this. Let's finish up this way. Let's say for each of you, you're going to be right. So what would be the best investment or two, whichever you prefer, to capitalize on your viewpoint over the next year? So I'm going to go make a trade today based on what you say. What do you think is going to be the best way to capture what you think in a year, Jim, and then ask you again, David?
So let me answer the question. First of all, by answering a basic question as to what should investors reasonably expect before we go with what they should be doing. So Jeremy Siegel updated his book Stocks for the Long Run in the last year.
Oh, that's animal spirits right there.
Yes. In the book, he makes the case as to what is the reasonable expectation that you should expect out of the stock market going forward and out of the bond market, out of bills, out of gold. 8% stock market returns, 5% bond market returns, 4% bills. You can see gold is 2.1 and CPI is 1.4. That's what he expects. But let's go with the top half, the investments of stocks, bonds, bills. The reason I want to bring that up is I know the stock market's up 18% a year. I know people think that they've got a birthright to get a 20% gain every year. I know the crypto crowd expects 20% a week. But the realistic expectation you should expect is 8%. The realistic expectation you should expect out of a blended portfolio of riskier assets, less riskier assets, is around 7%. It is not 10, 12, 15%. Those are speculative investments, and we all make them, and we can all be right or not right on those speculative investments. In that environment, the bond market, bear market, has done something we haven't seen in 30 years. It has made the bond market a competitive investment unto itself with the stock market. It is yielding over half of what you should get out of the stock market, out of a blended investment with a lot less risk. This is far different than 2019 when there was no yield. And we used to talk about the 60-40 portfolio. The only reason you held bonds was crash insurance. I don't think you need to hold bonds anymore for crash insurance. I think bonds can be with their yield all to themselves, can be a good investment. So where should you put your money? I think you should have a decent amount of your money in the bond market. Grab the yield now. Even if I'm right and the yield goes up and it produces price losses, those price losses will be cushioned by that yield. Or if you put your money with an active manager, or you put your money in T-bills at 4.5, or the 2-year note, or something along those lines, that you can get a decent yield there. I think that that's a good place to have your money. It's got far less risk and it gives you most of the stock market. Now that I've said that, speculatively, where would I be investing speculatively? I like gold. I like tips. I have the opinion that the tips break-even rates, especially short-term 0 to 5 year, which are well under about 1.5% over the next couple of years, meaning that they're pricing in about a 1.5% CPI rate over the next couple of years, I think is undervalued. By the way, the tips are an awful predictor of what usually happens. So they constantly provide you with opportunities because they're never right. They're either way too high or way too low. So they're a very good instrument to pick in that regard. So I like the tip security. I like the dollar. I think if yields are going to go up, there's a high degree of correlation. I'm going to use the DXY between the dollar index and the 10-year yield. The 10-year yield is going to head up. I think that the dollar is going to head up. So I like DXY as well too. And cheap crest commercial, we do run an ETF that is a long only fixed income ETF, WTBN, and a lot of what I just described is what we're doing in that ETF.
So we should buy that thing's 3-time levered, huh, Jim?
Yes. Yeah.
Okay, David.
Well, I mean, I agree with a lot of what Jim said, except if I had a higher yield forecast and I look at the convexity, and I'm always looking at bonds on the total return standpoint, I don't think I'd be bullish on bonds. But I think that the trend in inflation is down, and I think that the economy is going to deteriorate. I know I've been saying that for a while. It's like the boy who cried wolf, to which I say, just remember that the wolf does show up at the end of the story. I'm bullish on because I think that I think you can make decent money at the long end of the curve. I'm not overly fussed about fiscal policy. Of course, I think everything both of us are saying, Jim, after November the 5th, that one party rule, I think, is going to upset the apple cart at everything. I'll probably be loading up on inflation protection if we get one party rule. Either one, it's not going to be good news, but I'll be on guard for that. But I do like the long end of the bond market. Point number one. I do like gold. I think that the Fed is going to be playing catch down to the rest of the world. They raised rates the most, and I think they'll be now cutting rates the most. So I think that the dollar is, which already has been in a corrective phase for most of this year, will weaken. It's not the only reason I like gold. I like gold for other reasons as well. But all you have to know is the direction of the dollar, the direction of interest rates to know if you want to be bullish on gold. I call it the bond bullion barbell. Those are high conviction trades for me. And I'd say that, look, you want to invest in visibility. And I'm not really anti the stock market. There's sectors that I do like. We've liked utilities for a long time, not just for the fact that they're bond proxies. I call them bonds and drag in the stock market and their yield and dividend payout characteristics, but they've been re-rated with the increase that's secular in power demand. Utilities are being re-rated as defensive growth. So I like utilities and also defense stocks. If you're looking for visibility, there's not a country in the world that isn't dramatically increasing its defense budget. And of course, we're living in a shall I say, dystopian world that probably making George Orwell roll over in his grave, but that's what we're in. So I could give another list, but I'd say that visibility in the stock market is clearly defense stocks, great place to be, utilities, great place to be. Those are secular trends. And I'd say globally, Japan still trades quite cheaply. 38% of their companies in the topics trade below book value. It looks like the BOJ is going to drag its heels on taking away the carry trade and raising rates aggressively. So I like Japan's been a long-term buy for us. That's not going away. And I think if you're going to play the China trade, I'd rather do it in Hong Kong, to tell you the truth. I think it's safer. There's no geopolitical risk there. and it's trading. I mean, Jim, you correct me if I'm wrong. I think that it's trading at a 10 multiple. Hong Kong, which has swung from deep red to deep green. I'm not saying jump in now, but if you're looking for value, the Hang Seng as a major emerging market stands out as very deep value. It's trading at the same multiple that the S&P was back in the summer of 1982.
Well,
If I
that's
could jump
terrific.
in,
Oh, go
if I
ahead,
could
Jim.
jump in real
Yeah.
quick, just to buttress something Dave said. If you look at the betting markets, if you look at Nate Silver at Silver Bulletin and the like, the election between Harris and Trump is too close to call. And maybe November 4th, the day before the election, it's not too close to call, but it is right now. But the overwhelming belief within the betting markets and the models and everything else is divided government, one way or the other. In fact, what they expect is the Senate will flip to Republican and the House will flip to Democrat. So both of them will flip both ways. So what I'm trying to argue is I agree with Dave that if we wake up, November 5th, 6th, 7th, and start to realize that we had a blue wave or a red wave, that is going to be a big surprise.
Jimmy, outside of the Camp Kotok trip a few years ago to Montana, I don't think I paid as much attention to the state as I have over the course of the past couple of months.
Well, listen, guys, that was terrific. Thanks for sharing your views, and thanks for sharing your investment ideas that would fit with your views. And you guys aren't too far apart, really, on the investment side, even though you kind of disagree on the overview. Probably what you should plan on doing, revisiting this topic in about 6 months.